Wall Street bet billions of dollars against the laws of physics, and physics won. The result was a violent 4,700% explosion in the stock price of a company called Wolfspeed, wiping out short sellers and shifting massive amounts of capital toward the engineers who understood the science. To see why the market got this so wrong, we have to look at the power requirements of next-generation AI. Modern server racks are scaling from 150 kilowatts to nearly a megawatt, creating a massive electrical load that the current grid wasn't designed to handle. When standard silicon chips are subjected to the voltage required by these AI workloads, they reach a physical breaking point. They cannot dissipate heat fast enough, leading to catastrophic thermal failure and hardware that literally melts. This thermal barrier created a ceiling for the AI boom, making the search for a new high-voltage material an existential necessity for data center operators. The solution turned out to be Silicon Carbide, a compound semiconductor that can handle high-frequency power at temperatures that would vaporize standard silicon. This material is known as a wide bandgap semiconductor. In standard silicon, the gap electrons must cross to conduct electricity is narrow, only 1.1 electron volts. Silicon carbide sits at 3.26. That wider gap allows the material to withstand 10 times the electric field strength of 100-volt DC data center architectures that route massive power streams without the energy loss or heat generation that plagues traditional systems. Silicon carbide provides the mandatory physical backbone that allows AI servers to scale without catching fire. While the engineering world saw a revolution, the financial world saw a disaster. Wolfspeed had spent years and billions of dollars attempting to manufacture this physical solution at scale. Wall Street analysts focused on the company's massive cash burn. Wolfspeed was constructing the world's first fully automated 200mm fabrication plants, an effort that required enormous amounts of upfront capital. At the same time, the primary revenue stream for these chips, the electric vehicle market, began to soften globally. This left Wolfspeed with massive bills and decreasing cash flow. By late 2025, the debt burden became unsustainable, forcing Wolfspeed to enter Chapter 11 bankruptcy to restructure its obligations. Analysts looked at the spreadsheets and saw a failing automotive supplier. They missed the fact that Wolfspeed had spent that debt constructing the only fully automated, vertically integrated 200mm production pipeline in existence. Expecting the company to go to zero, hedge funds began shorting the stock en masse, with short interest eventually climbing to over 30% of the company's available shares. However, the bankruptcy process achieved a result the shorts hadn't calculated. It wiped out roughly $4.6 billion in legacy debt. Wolfspeed emerged from restructuring with a clean balance sheet and fully operational factories that would take any competitor a decade to replicate. In May 2026, a report from Citrini Research acted as the catalyst that broke the market's bearish consensus. The report argued that Wolfspeed's massive fabrication facilities were strategically irreplaceable assets, sitting at the central node of the global AI data center grid. The Citrini report revealed the flaw in the bearish model, valuing a critical AI infrastructure asset using the metrics of a distressed auto parts vendor. Institutional demand surged as buyers realized they could own the physical backbone of the AI power grid at a post-bankruptcy discount. This triggered a short squeeze. Because short sellers are effectively trapped in their positions as the price rises, they are forced to buy shares at any price to prevent their losses from becoming infinite. This created a violent feedback loop. Forced buying by short sellers drives the price higher, which forces even more short sellers to buy, resulting in a vertical explosion on the chart. Within months, Wolfspeed stock rocketed from its 38-cent low to over $80, a historic recovery. The market weaponized Wall Street's own ignorance, resulting in a 4,700% wealth transfer from those who bet on spreadsheets to those who bet on physics. Spreadsheet models are projections. Material science is a hard reality. Every step of the AI revolution remains bound by physical infrastructure and the laws of thermodynamics. To see where technology and markets actually intersect, subscribe to Synapse Capital AI. When a financial model bets against the laws of physics, physics always wins.